stock market crash. Has a crash begun? This is where traders and investors battle together. In this video, I'm going to share my thoughts on how you might feel right now. Everyone says, whenever I buy a stock, it always goes down. Guaranteed, every time. I start buying a stock and it goes down. How many have you ever experienced that? Many people have. It happens all the time. But right now, we're in the middle of a crash, which is gaining speed. And as you know, I am in margin. I put my money where my mouth is. Here is my position, 46. It's a significant amount. And it's a very red day in the studio today. So let's talk about the psychology of what is an investor as opposed to what is a trader. It's going to be a personal, emotional journey with me now. So buckle up, and I'd like your thoughts below. Perhaps you could comment below and tell me what you think of this. Remember, the economy and the stock market are two completely different things. Just because the economy is doing well doesn't mean the stock market necessarily does well. They are two different animals, and the economy is 6 months behind the stock market. People are buying future prices, they're buying businesses for where they expect them to be in the future. So you can't correlate the two. They are very different. Traders and investors are very, very different. Wall Street are traders, they're not investors. If they sense the markets are going down for any reason, they dump the stock. Does that mean the companies are doing worse today? Well, potentially they are. We've just heard from Tesla. No surprise there. The stock was overbought. The company isn't particularly doing much worse. It is doing a bit worse, but it's in kind of relationship and in keeping with the economy as a whole. We know everything's slowing down. That was the intention of the Fed. That's why they raised rates, to calm the economy down. Less supply, less spending, then the economy cools. They can lower wages because businesses are laying off, so they don't have to pay such high wages, and so it goes on. The Fed have been tightening at historic levels now for a long time. It takes a while for the true effect to kick in. The true effects have now kicked in. And this is the point where the Fed can go too far and damage the economy. We don't want the economy to go, and the stock market and the whole thing to go into recession. We don't want a depression. We don't want that to happen. I don't believe that is going to happen. What we've got right now is a rotation. The mega caps made loads of money. We're looking at Donald Trump winning the election. We know his opinions on certain stocks, and people are taking their money out of high tech, buying the lower cap, the small caps, the lower quality stocks. They got a bit of a bounce, and some of those have now sold off. But now the general economy, the general market is going down. Now, as a trader, you might look at this as an opportunity to get out of the market, wait for it to settle, start buying again. But the trouble is, nobody knows when the bottom comes. Charts can help you. Sensei can provide some great charts for you, support levels, resistance levels, all the rest of it. Historic positions that have happened in the past, giving you the belief it may happen again by a certain percentage. But generally speaking, unless you are an oracle and you've got a crystal ball, which I have, by the way, nobody knows how far the markets are going to drop. Now, we've seen bigger drops than this. Overall now, we're down about 3 or 4% since from the top. That's a reasonable drop, but it's not by any means an all-out crash. Some people are saying we're about to get the biggest crash in history, 20, 30, 40, 50%. I don't see it. I see strong businesses that are simply being sold as rotation. And we know the Fed have done their job. Their job was to cool inflation and get it back down to 2%. We are there. We are there because the metrics they use are lagging indicators. Europe knows it, UK know it, India knows it, America know it really, but they're just using lagging indicators. So on Friday, we're going to get another PCI print, and I think we're going to see another drop in inflation like we've done over the last few months. And I think there's a very good chance that we will get rate cuts on Friday. I've been saying for 18 months that in the summer of 2024, enough pain would have been caused to the economy and the markets, enough damage would have been done, and now it's time for the Fed to cool down. When they cool down, it will bring more money back into the markets. It will be less attractive to hold your money in cash. It'll put more money into new emerging businesses and all the rest of it. They've done the damage. They've done what they needed to do. It's now time, desperately time, to lower rates, because now the Fed are in danger of deflation. That's when you go negative. And we don't want that. We don't want a recession. We don't want a depression like the 1930s. But things are very different than they were then. We don't have that sort of economy. We have many great businesses that are solving problems. We have many great innovations that are going to make the world a better place financially and boost the economy and boost business. We've got businesses we've not had in the past, looking now at going into space and landing on the moon and landing on Mars. These are all businesses. These are all opportunities for investors. AI, EV tolls, solar, wind, and all of these things are happening now. And for that reason, I am investing in the economy. Now, for me, I always do what I say and I say what I do. I am using margin. Let me explain that. People often say you should have money on the side for days like this. That is a ridiculous statement, and let me explain why. If you are an investor, you're buying businesses. You hold those businesses, and those businesses earn money for you. That's what an investor is. So I spend my time here on YouTube earning money so I can invest as much money as possible, so I can buy as much of the businesses that I possibly can. Thereby, my returns are greater. Okay? There's no sense to me having money just sat in cash. I'll explain why. There's a thing called the FIFO rule: first in, first out. The stocks I bought first originally, they're all up 20%. They're safe. Even if the market drops 10% today, they're still 10% up. That money, that investment has beaten inflation. And if that money had been earning interest, it wouldn't have earned that much interest either. So what would be the sense in having the money sat in the bank waiting for days like today? None. As Warren Buffett says, don't wait for the pullback. Stay invested. Concentrate on earning money and buying into the market. So if the markets drop considerably, I can sell, and the stocks I sell will be for profit. I don't want to sell them because I want them to work for me. I want them to pay me dividends and so on and so forth. But I do have that money. And even if we do have an almighty crash, I'm probably still going to be up 10% on that money. Like I say, more money than I would have made in cash or in interest. So I'm fully invested. Now, as I earn money, I just keep buying, regardless of the price. I try to find a little dip in the market, but again, I'm not trying to time the market. Overall, over the next 10, 15, 20 years, it won't make a difference. It won't make a difference at all. So I just keep buying. That's when the stocks are going sideways or they're starting to trend up. I'm buying more. Not using any margin at that point because everything's just going up, and there's no point borrowing money just to go sideways, or there's no sense paying interest for stocks that are going up. You don't do that. You put your own money in, and every month I earn money on YouTube and I put more money in, and so it goes. Well, we've had that time, and all that money is now invested, and what normally would happen is I'd wait for next month and get some more money and I'd buy some more. However, we're now on a downtrend. We're not going sideways anymore. We're not going up anymore, but we are going down. And because we're going down, this is my opportunity to buy stocks at lower prices, bearing in mind a week, a month, 6 months, a year from now, 10 years from now, I know they're going to be up. So that is the very definition of investing. Now you might say, yeah, but you're now paying interest on the money. Yes, I am. 6.75, which is about to come crashing down. I expect 3 rate cuts this year. So once we get rate cuts, everybody else is going to be piling in with margin because money will become cheap again. So I want to buy in on the way down. Now, that's why I'm doing it. Now, margin isn't right for everyone because the most important thing is your emotions. If you stress over it, if you do it too much, if you need the money and you need to take the money out of your account to pay bills, you shouldn't be doing it. This is for people that have a temperament that they can have control over, discipline. Don't get fearful. Don't worry tomorrow and sell on the way down and then buy up again and all the rest of it. You don't want to be like that. You need a very calm head, and you've got to take your time and have patience and just let it happen over time. Now, as we hit the bottom, at some point we will. There won't be any more decline. That'll be it. And that's the point we'll know where the bottom is. We won't know it until we get there, but we'll know after by about a month or two, and it will take that long to know where the bottom was. And off we'll go again. Now, as we start to go up, I won't be buying. Everybody else will be buying, hence why the market's going up. I will be enjoying the stocks I own at the lower prices and spend the next 2 months, 3 months, 5 months, 5 years, doesn't matter, paying back my margin. Now, if you borrow $1 on margin or $1 million on margin, it shouldn't make a difference. What I mean by that is you might say, well, I'm okay. I'm okay with it temperament wise to spend $1 on margin. I'll borrow $1. I'm okay with that. But I would definitely not borrow $1 million. Well, let's explain that for a moment. If you look at my portfolio and we look at my margin position, you can see right there. If I go on to the view details so you can see exactly. This is my position. You can see I've now got a 60% buffer. The market has to drop 60% and then some, because it'll be more on top of that because it's kind of built into it. But 60%, we're not going to see a 60% drop. And even if we saw a 61% drop, I would simply have to raise my my balance by a couple of bucks to get above that level, and I'd be fine anyway. It wouldn't be like suddenly I've got to sell all my shares and run to the hills. But I've got a 60% margin, a buffer, because my portfolio is currently worth $79,000. It doesn't take into account what's in my Roth. Obviously, it's separate. That's always money I can get hold of as well. I will pay a tax penalty, but there's money there. But if my portfolio was $1 million, which it will be in about 6 years' time, then I can borrow, and I would borrow, somewhere in the region of $400,000. It would be exactly the same percentage. The question is, could you live with that? Could you live with borrowing nearly $500,000 on margin? Well, it's the same as if you'd borrowed just $1. If you only had just over $1, it's the same thing. It's about the percentage. It's not about the number. The more money you have, the more you can borrow. It just makes perfect sense. So for me, 60% is my very comfortable buffer. A month from now, when I get paid again from YouTube, I'll have another couple of $1,000. I'll put that in. That will take my buffer to 62%. I can buy some more. I could go on and on and on. I could spend all of that money right there and put myself right on the edge of a margin call, because I still believe we're going to go up soon. I don't think there's much more to go down. However, I don't know. And also, that's my tolerance. That's the risk that I take, not because I don't believe in the economy, but because I've got to sleep at night and it makes me feel uncomfortable to go further. I've experienced margin before. I know what it feels like. I wouldn't want to be 80, 90% in margin. I would feel uncomfortable, even if I was bullish and believed in everything. And remember, no one knows what's going to happen. That would make me feel uncomfortable. And it would take me about 30 years to pay it back. Now, paying it back over 30 years isn't really a big issue, because if you keep earning money and you can increase what you're earning, and you're buying shares which you bought 30 years ago, essentially, they're a lot less than where we are in the future. Does it really matter? Well, the only thing it would be a concern for is if interest rates started going up again. If interest rates suddenly went to 10%, because remember, Robinhood can increase their margin fee, their interest rate at any point. They don't have to wait for the Fed. They could go, we want to make more on our margin. We're going to charge you 12%. If they did that, and they could do that today, they could announce that. But they know if they did that, many people would sell and they wouldn't make the money. So there's no point doing that. But they could. So because that's always a possibility, you can't just keep buying and buying and buying and buying, even if you think it's not going to go any lower, because it would just be so difficult to sleep with. It just wouldn't be worth it. Your health is everything, right? So there's my thoughts about my current position, and you're probably facing the same. You're seeing the markets go down and you're thinking, what do I do? And I'm not in any way saying this is financial advice. I'm not in any way saying you should use margin just because I have. This is my thoughts. I would only use margin for the S&P. I wouldn't use it for any other stock, even great businesses like Amazon and Microsoft and Google, because you've seen the volatility that they can have. Things can go wrong with individual stocks. Surprises can come along at any point. I wouldn't use margin to buy any stock, no matter how good it was or how good I thought it was. But I'm very comfortable with it on the S&P. The definition of an investor is to invest, buy a business, hold it, and let the business grow and pay you a profit, a dividend, an income, whatever you like. A trader, however, is looking for the buy zones and sell zones to get in and get out, and that's fine. But remember, 95% of day traders lose money, and it's proven over history. If you've got the patience, and if you're prepared to stay in the market, if you're prepared to buy the dips on the down days and you stay the course, when people say the S&P only makes on average 10 to 13% a year, which is correct, we have explosive years like this, but overall, on average, it's about 10 to 13% if you include inflation and dividends. However, you can beat that massively by buying the dips, because it will bounce back and you'll make more than the 10% in the year. But you'll do it in a safe, or at least the safest way probably possible on the stock market. So that's why I'm fully invested. That's why I'm using margin. Makes no sense to me to sell now we've started to fall. It's a time to buy. My emotions are in check. My knowledge and my understanding is in check. So I'm all good with all of that. So I'm very, very happy. Would I prefer it going up? Well, not really, because I don't make any money when it goes up. I make money in two ways. When the stocks go down, I buy more and I get paid in dividends. So So the more I own, the more dividends I get, the more money I earn to buy more. Going up doesn't make me any money until I choose to sell in 10 or 20 years. To see my portfolio up 100% today is exciting, and we turn the lights green, and it's very exciting. But it doesn't mean anything because I'm not selling it and buying a car or paying for a holiday or doing anything. It just sits there. And there's nothing wrong with that. But the real investing is done on the red days. So my message to you is, are you an investor or are you a trader? You can be a bit of both. You can flip-flop from one to the other. I've traded, I'm also an investor. Right now, I'm just solely an investor. What are you doing now? Are you buying the dip? Is there more to come? Some people will tell you on YouTube to get views because it's all doom and gloom that a 30% crash is coming. Maybe, no one knows. Certainly those who make YouTube videos don't know. I don't know. I've no idea. But I do know that over time, I'll be okay. I've got to stay the course, keep my emotions in check, keep working. I turned up today when I felt really ill. I went, no, I've got to get up, got to make videos, got to earn some money. Otherwise, then I would be in trouble, right? I wish everybody the best. I hope you are not at home on your own thinking, flipping it, what do I do? Because if you are feeling like that, it'd be more important for me to know that you can call into the show, be on the show, be part of it, and get support from all our viewers. I wish you all the very best. When the clouds come over, it means the sun is coming next. It's inevitable. The sun will come out next. We don't know how long the rain clouds will cover the sky, but we know what comes next is the sunshine. Click above my head for all the links down below in the description, and over here, I'll put more videos you might find useful. I wish everybody the very best. Until next time, as always, take care of yourselves and each other.